Good afternoon. Welcome to another episode of the Lawron Ballard Show. I am so excited to be here with you another Wednesday. Forgive me for being a little late today. It's been one of those days, but I am excited to share with you all today. So let's start with news. I told you this, I've been telling you this the past couple weeks, and I will continue to say it. Today is the last time you will hear me talk about it, but the Kwong claim, it is due Friday. So if you are not familiar, if this is your first time watching the show, the Kwong claim is related to penalties and interest that you may have incurred during the COVID era. So from 2020 to 2023. The Kwong claim says that it was technically illegal for the IRS to charge penalties and interest during that time. And so if you would like to make a claim for that, for penalties and interest that were wrongfully charged, now is the time to do that. That must be postmarked or uploaded to your IRS portal by this Friday. So the time is running out on that to make sure that you get that filed. What else is going on in news? So this is interesting. Everybody is all excited about AI and what AI can do. I actually had a good friend of mine reach out to me who was trying to do some accounting stuff and was using AI to help. Well, the IRS has just released guidelines specifically for tax preparers. But you should know this as well if you are someone who uses a tax professional to work with you, that they should now be disclosing their use of AI, how it's being used in the practice. And the IRS is encouraging that any savings in terms of time that is acquired or achieved by the use of AI by tax professionals, they are endorsing that people tax professionals pass that on to their clients. And so I just want to encourage you, if you have not been seeing any of that information being passed on to you, or any savings being passed on to you as a result of the use of AI, I want to just encourage you to check in with your tax preparer to see what information they can share with you. I know one thing that I am doing with my clients in my practice is that it is disclosed in any contracts that we use AI, and we are using VPN where appropriate. We are not allowing for any testing on the data. And like I said, it's disclosed in the contract. So we want to make sure that our clients, their information is protected, and they are also aware of the fact of the use of AI. So just make sure that as you're working with a tax preparer, that they understand and are disclosing to you how they're using AI so that you can sign off on that. That's super important. So as always, I'd like to jump into a case study talking about how tax planning is used to lower your tax bill. So I have a case study here with a construction worker, a construction contractor who was in a contracting business, who made $864,000 in their tax year. And through a series of strategies, were able to lower their tax bill from $330,000 to $62,000. Now, for the folks who are watching who are like, listen, that's not my tax bracket. Is any of this stuff going to be relevant? Yes, yes, yes. I want you to stay plugged in, because the things that I'm talking about, some of them are at a higher level, but some of them apply regardless of income. And so I want you to understand that when we're talking about tax planning, this is not just for high net worth individuals. This is for folks from all income levels. You should understand how to use the tax code in your favor. So for this client, their business made 4.5 million in revenue, and they used 5 strategies. If you have watched the show before, you already know that I say 3 to 5 strategies can change your life. Literally 3 to 5 strategies can change your life. You do not need a whole smattering of tax strategies to lower your tax bill significantly. So this client only used 5. The first one was an accountable plan. We have talked about this. This is essentially how you reimburse yourself from your business for things that you pay for personally. The second one was the Augusta rule. You rent out your primary residence to your business and you take a deduction from the business while also recording income or not having to record that income on your personal tax return. For this client, they had a big opportunity with a donor advised fund. We've spoken about this before as well. So for those of us who love to give back, who love to give to charity, who have a little bit of extra capital, this is a great opportunity. And so this is how the donor advised fund works. You essentially lump together all of your donations for a period of time. It can be 1 year, 3 years, well, more than 1 year, but 3 years, 5 years. And so if I donate $10,000 normally every single year with a donor advised fund, depending on how much cash I have, I could bundle all of those donations, and instead of making 10, I would make 50, and you would then be able to take that deduction of 50,000. I want to talk really quickly about charitable giving, though. I actually met somebody recently who had a charitable giving strategy, who it wasn't 1-to-1, it was like a 1-to-3, which was awesome. So you would contribute $25,000 to buy some old documents, and you would then in turn donate those documents to a college, a university. And the nice thing about doing that, so you bought it for $25,000, you donate it, the fair market value is actually the difference between those two. And so that's a really nice way for you to get an even higher amount. This client didn't do this, but there are ways for you to increase that charitable giving deduction depending on the strategies that you are familiar with. Next thing, the client hired their kids. So they had a business, they hired their kids into the business. And then the last thing was maximizing retirement. They also had some other things like cost segregation because they were a real estate investor. They brought on a board of directors for their business. They had business travel expenses. They had the opportunity to do equipment leasing, travel expenses for their real estate. They did a late S selection. I don't technically consider that a strategy. I consider that reconfiguring your operation, but that also garnered some savings for them. And then they had the opportunity to do a family management company. So there's a whole lot of things that they had available to them. But again, they only selected 5, and those 5 strategies got their tax bill down from $332,000 to $62,000. That's almost a $270,000 in savings, which is major. And so that is the power of tax planning. I think next week, what I want to talk about, so one of the things that's super important to me and when I'm working with clients is I don't want you to just save money. I want to start talking about where should the money go that you save? Like, it shouldn't go to buy you a new car. We want to start thinking about how am I structured? If there's an economic downturn, am I prepared for that? What does that look like? What are some things that I can start to do now to position myself to be ready in the future? So we need this to be a full life cycle in terms of tax savings, using that to create your own personal economy. We don't care about what the US economy is doing. We care about what is the economy of you doing. And so that's where we're going to go next in our series, preparing and building the economy of you. So now I want to just check with my folks on TikTok. Thank you so much for the hearts. I'm so glad you guys are here. Hello, hello, hello. If you have any questions, thank you so much, Helena. If you have any questions, please do feel free to drop them in the comments. I so appreciate all the likes. If you are on TikTok, please share the live so that we can get some other people this information. And if you are joining on YouTube, thank you so much for being here. My LinkedIn family, thank you so much for being here. So now I want to talk about some 3 strategies, 3 things W-2 employees can do to lower their tax bill in 2026. If there is one thing I hear more often than not, it is from W-2 employees who say that there is no way for them to lower their tax bill, that the tax code was simply written for people who had businesses or invested in real estate. But I want to let you know today that that is not the truth. So here in the next few minutes, I am going to share with you 3 ways that you can lower your tax bill as a W-2 employee. So let's jump into it. The very first thing that you can do is retirement. So most people already know this, but I want to just kind of explain the mechanics of how this works, especially when we're talking about from a federal income tax perspective. So from a federal income tax perspective, when you contribute to a retirement account, your taxable income gets lowered. And so when I say that, let's give an example. Let's say that your income was $500,000. If you contribute $15,000 to a retirement account, that $500,000 is no longer $500,000 from a federal tax perspective. It is now $485,000. So that is a very simple way, just a couple check boxes and an application that you would likely fill out through your employer to make those elections, and automatically you are saving taxes. The second thing that I recommend to clients who are W-2 employees, and honestly, this is the first step before we even make an election for retirement. I want you to work with your accountant, with your tax professional, your CPA, to get some projections. You cannot manage what you don't measure. And so it is so important for you to get some type of understanding of where you're going to end up for the tax year. And so having your tax professional prepare some projections for you, give you an understanding of what you can do, I would highly recommend doing so. So get those projections so you can have a baseline and then you can work backwards from there. The third thing that I would recommend is looking at what can you do in terms of health insurance or dependent care FSAs that you can establish that work similar to retirement in the sense that you can contribute money through your employer, and then that contribution further reduces your taxable income. So those are 3 very simple things that can help you lower your tax bill. Now, let's talk about some, so those are kind of the obvious things. Let's talk about the not so obvious things. So we just spoke about the things that you can do from your job perspective, or we'll call it employer-based tax strategies. Now let's talk about what you can do outside of your 9-to-5 job. The second thing that you can do is contribute to causes that you care about, contributing to causes that you care about. So there is something that's really, really nice that happened for 2026. So prior to 2026, if you contributed, if you donated to a charity, the only way that you could take advantage of that donation is if you itemized. But depending on where you live, you may not be able, depending on where you live, your income, other factors, you may not qualify to itemize. It actually may be more beneficial for you to take the standard deduction. Well, for after the One Big Beautiful Bill passed, there is now a deduction regardless of whether or not you are married, that is a deduction for charitable contributions. So if you give to charity, if you give to your church, if you give to the Red Cross, if you give to UNICEF, whatever organization that you give to, you are able to take a deduction. And so I highly recommend that my W-2 employees take advantage of that. If they are in the position where they can itemize, then, give as much as you are comfortable with. If you are not in the position where you itemize, make sure that you're giving at least $1,000 if you're single, or $2,000 as a married couple, so that you can take advantage of that charitable giving deduction that is new for 2026. The third thing that you can do, if you have a little bit more cash at hand, the third thing that you can do to lower your tax bill for 2026 is to look into short-term rentals. I'm sure you have heard me say this before, but the short-term rental loophole is one of the biggest and most cost-effective ways. Let me rephrase that. It is one of the biggest and most advantageous ways for you to lower your tax bill. How does it work? So normally, for you to get the benefits of real estate, you have to be a real estate professional. However, if you set up your property as a short-term rental, you get the same benefits as a real estate professional by running it as a short-term rental. There's a few specifics that you have to keep in mind. Things like the amount of hours, 100 hours and more than anybody else, a minimum of 100 hours and more than anybody else. The average stay, 7 days or less. There's certain things that you have to have in place. But if you are someone who is self-managing a property that's already on Airbnb, I would highly recommend and make sure that your tax professional has been treating that property correctly. I cannot tell you how many times I've looked at tax returns and they have not been done right. So you got to make sure that is done properly. But the real estate professional, the real estate professional status normally is not available if you are a W-2 employee, especially if you are unmarried. But the short-term rental, I have seen literally move mountains from a tax perspective for my clients when it's applied appropriately. So those are three things that you can do as a W-2 employee to lower your tax bill. If at any point in time you want to start a business, having a small side business, a family business, is also an opportunity for you to lower your tax bill, because now we've opened up a whole bunch of things to help you in terms of the tax code to help manage that bill. So, but in terms of W-2 employees, three things that you can do to manage your tax bill this year. Number one, make sure you are optimized in terms of employer tax mitigation opportunities. Number two, you got to make sure that you are giving to charity. And number three, if you have the capital and the stomach for it, then you want to make sure that you take a look at short-term rentals or starting a small family business, because by doing that, you open up a lot of opportunities for yourself and for your family to take advantage of the tax code. So before we go into questions, I want to just go back to TikTok and see if there's anybody here who has any questions, anything you want to know about taxes, anything that has happened personally that you, okay, so Helena wants to learn economics. That's a big topic, Helena. All right, let's see if there's any comments here on LinkedIn or YouTube. Awesome. So let's go to some questions before we wrap up today's session. Okay, so first question, should I choose a traditional or a Roth retirement account? Excellent question. This, my answer, if you've watched the show before, you know my answer when it comes to tax questions is always it depends. And the reason why it depends is because it is dependent on what you're trying to accomplish. But here's the nice thing about Roths. Let me explain to you the difference between a traditional or a Roth account. A traditional is what you think of in terms of it gives you a tax break. Now, the most common way you would see that is being a W-2 job. A Roth retirement account is something a little bit different. It functions the same in terms of it is a savings plan for retirement, but you actually don't get a tax break in the current year for a Roth. You get a tax break in the future. Let me tell you when this is a good opportunity. For my clients who are my folks who are about to retire, if you are about to retire and you know that your income is going to drop, I highly recommend doing a Roth conversion, because at that point in time, the amount of tax you pay is probably going to be less than what it would be in the future. The other opportunity for Roth is if you know that let's say you are a recent grad, you could be a recent grad from medical school or out of college. At this point in time, when your income is going to be the lowest, you might want to consider contributing to a Roth, paying the tax now, because the tax rate, we don't know what the tax rate is going to be when you retire, but the assumption is that it's going to be lower now than it will be in the future. Standard versus itemized deduction, which is better? It is, again, it depends. It's going to depend on your circumstances, your scenario, what you have going on in your family. Do you own a house? Do you live in a high tax state? Do you pay mortgage? All of those things do you give to charity? All of those things would determine whether or not taking the itemized deduction versus the standard deduction is a better fit. Ultimately, you want to take the higher one. If you are married filing separate, then the conversation is a little bit different. How can I lower my tax bracket before the end of the year? Well, if you want to know, go back and watch earlier. But some of the things we talked about is funding a retirement account, funding health savings accounts. You can do something called tax loss harvesting if you invest in stocks and bonds and things like that. What is the difference between a tax deduction and a tax credit? Very good question. A tax deduction lowers your taxable income, whereas a tax credit is an actual dollar for dollar credit against your tax bill. As a business owner, should you be an LLC or an S corp? Honestly, depending on the business, for most businesses, if you started as an LLC, it's probably an okay option. As your business grows, then you'll need to revisit that. But starting out, you can absolutely be an LLC. Let's see if there's any questions from TikTok. All right, so if there's no other questions, I just want to take a moment to say thank you so much for watching the show. I hope that you have found value. If you have any questions about your tax bill, I am awesome. How are you? If you have any questions about your tax bill, if you have any questions about what you can do before the end of the year, please do not hesitate to reach out. And before I go, I want to let you know that Hilltown Advisors is taking clients. If you need any support, if you need any help, we would be happy to serve you. So until next week, I hope that you have an amazing day, and I will talk with you all soon. God bless.